Well, it's terrific. It was good to meet a lot of people I've known for many, many years, and to hear a lot of the past presidents go over the history of the MTA, and also to talk about what we see in the future. So it was a great experience, a great evening. Well, I'll be talking specifically about the secular and the cyclical trend of industrial commodity prices. That's commodity prices are not driven by weather and are very economically sensitive. And I'll be talking about the outlook for those, as opposed to debating whether the inflation, the main predominant force is inflation or deflationary. It's obviously deflationary, because otherwise why would central banks be expanding their balance sheets? What we're talking about is whether they can get around that and cause a little bit of inflation. And I think that's really the, and what the markets are saying about that right now. Well, a few years ago, Dow Jones Indexes approached me with an idea of creating an index based on my 6-stage business cycle work. And so we developed an index called the Dow Jones Pring Business Cycle Index, which we now use as a kind of a basis, or the same strategies are used also in our ETF, with the symbol DBIZ, the Pring Turner Business Cycle Index. And that is what we call an all-season strategy, because we have strategies that are investment friendly through all stages of the business cycle, whether it's inflationary or deflationary. Well, we have 3 models, and the models determine the stage: one for bonds, one for stocks, one for commodities. And right now the bond model is bearish, stocks and commodities are bullish. And so that puts us in stage 4, which tends to be an inflationary stage. Though so far in this particular stage 4, we haven't seen a lot in terms of rising commodity prices, in fact quite the reverse. Yes, but most definitely. It looks to us that we're certainly in a secular bull market for a cyclical bull market for yields. We are seeing a few signs that maybe the secular or very long-term trend is also reversed to the upside in terms of yields. Well, eventually, of course, that feeds back into the stock market, but it's impossible to say what it means right now, because the leads and lags of interest rates going up and the stock market going down vary from cycle to cycle. And also, it's complicated in the current cycle because short-term rates are still down, of course, because the supplier of credit, the Fed, is injecting lots of liquidity into the system, and that's obviously holding short rates down. So we're not seeing a typical cycle at this point. I think the biggest change is the change in time horizons. When we used to plot on paper, as opposed to plotting with software, we used to plot very long-term charts. Now people tend to be doing a lot of intraday trading and so forth, have been for the last 10 or 15 years. So I think the time horizons of people is shortened considerably. And I don't think that's a good thing, because one of the key things that I teach in terms of psychology is to be as objective as possible. And the closer you are to the market, the less objective you can be. So every time you call your friendly broker, you're being drawn into that emotional. Every time you watch some TV program, you're being drawn into that emotion. And you want to keep it as objective as possible.